There are three charts that exist right now, today, that if every retail investor in America saw them at the same time, the silver market would break by Friday. Not next month, not next year, Friday. These are not hidden charts. They are not classified. They are not locked behind a Bloomberg terminal paywall. They are publicly available. Anyone can pull them up. Anyone can read them. But almost nobody does, because the financial media won't show them to you. Your broker won't show them to you. CNBC will never put these on screen. Bloomberg will never run a segment on them. The Wall Street Journal will never print them above the fold. Why? Because these three charts, when you see them together, when you lay them side by side and understand what they are telling you, they destroy the narrative. They destroy the lie that silver is fairly priced. They destroy the lie that the vaults are full. They destroy the lie that paper and physical are the same thing. And they expose with mathematical certainty that the bullion banks, the ones who set the price, the ones who control the COMEX, the ones who run the algorithms, are running the largest legalized theft operation in the history of commodity markets. I'm going to show you all three charts today. I'm going to explain what each one means in plain English. I'm going to do the math live, and by the end of this video, you will understand exactly why JP Morgan, HSBC, and Scotia don't want you looking at these numbers, because once you see them, you can never unsee them. And once you understand them, you will never trust the spot price again. Chart number 1. The COMEX registered inventory drain. Pull up chart number 1. This is the COMEX registered silver inventory from January 2021 to today. If you've never seen this chart, prepare yourself because it looks like a patient flatlining. In February 2021, the COMEX held approximately 152 million ounces of registered silver. Registered means available for delivery. This is the silver that actually backs the futures contracts. This is the silver that the COMEX points to when someone says, "Prove you have the metal." This is supposed to be the foundation of the entire paper silver market. Today, that number is approximately 35 million ounces. Let me say that again because I need you to absorb the magnitude. Registered silver has dropped from 152 million ounces to 35 million ounces. That is a 77% decline over 4 years. While the price barely moved, read that sentence again, a 77% decline in deliverable supply, and the price went from roughly $27 to roughly $32. An 18% increase? Supply dropped 77%, price went up 18%. In what universe does a 77% supply reduction produce only an 18% price increase? I'll tell you what universe. A manipulated one. A universe where the price is not set by supply and demand. A universe where the price is set by algorithms and paper contracts and bank trading desks that have a vested interest in keeping the price low. Because those banks are short. They are massively, catastrophically short silver. And if the price reflects the actual supply situation, they are bankrupt. Let me walk you through the timeline because the details matter. In January 2021, the Wall Street bets movement spilled over into silver. Retail investors started buying physical metal at a pace the system had never seen. The U.S. Mint sold 4.9 million Silver Eagles in January 2021 alone. Dealers sold out. Premiums spiked to $10 over spot. The internet was on fire with silver squeeze posts. And what happened? The COMEX didn't break. The price spiked briefly to $30 and then got hammered back down to $24. The media ran victory laps. Silver squeeze fails, they said. Reddit loses again, they said. Silver is not GameStop, they said. But here's what they didn't tell you. While the price was being smashed back down, while the algos were dumping contracts, while the media was declaring victory, the registered inventory started draining, quietly, steadily, relentlessly, because the squeeze didn't fail. The squeeze went underground. The retail buyers didn't sell, they held. And they kept buying, month after month, and industrial users kept consuming, month after month, and the registered vaults kept bleeding, month after month. 152 million, 140 million, 125 million, 110 million, 95 million, 80 million, 60 million, 45 million, 35 million, That is not a market that is functioning normally. That is a market that is being drained. That is a bathtub with the plug pulled, and the banks are standing next to it telling you the water level is fine while it swirls down the drain. That is chart number 1, a 77% decline in deliverable supply, and the price barely moved. If that doesn't make you angry, you're not paying attention. If that doesn't make you suspicious, you're not thinking. And if that doesn't make you buy physical silver, you're not listening. Chart number 2, the paper to physical leverage ratio. Now pull up chart number 2. This one is even more disturbing. This chart shows the ratio of paper silver claims to physical registered silver on the COMEX. And it is a chart that, if shown on national television, would cause a bank run on the silver market within 48 hours. Here's how it works. The COMEX trades silver futures contracts. Each contract represents 5,000 ounces. The total open interest, meaning the total number of active contracts at any given time, represents the total paper claims on silver. Right now, open interest is approximately 140,000 contracts. Multiply 140,000 contracts by 5,000 ounces per contract. That is 700 million ounces of paper claims. 700 million ounces. Now, how much registered silver is available to deliver against those claims? We just established that number, 35 million ounces. Divide 700 million by 35 million. That is a leverage ratio of 20-1. 20 paper claims for every single physical ounce available for delivery. 20. Let me give you an analogy because I want this to land. Imagine you own a hotel with 35 rooms. Now imagine you sold reservations for 700 guests, all for the same night, all expecting a room, all holding a confirmation email. What happens when they show up? Chaos, lawsuits, a riot in the lobby. That is the COMEX silver market right now. 20 guests for every room, and the hotel is praying that 19 out of 20 never show up. But here is where chart number 2 gets truly terrifying. Go back 5 years. In 2020, the leverage ratio was approximately 4-1. Still bad, still fractional reserve, but manageable. The system had buffer. It had margin for error. It could absorb a delivery spike. Today, at 20-1, there is no buffer, there is no margin. If just 5% of long contract holders demand physical delivery instead of rolling their positions or settling in cash, the COMEX defaults. 5%, not 50, not 20, 5. And what triggers that 5%? Fear, distrust, a headline, a whistleblower, a geopolitical shock, a single large fund deciding that it wants metal, not paper. Any one of those catalysts could trigger the cascade, and once it starts, it feeds on itself. The first person who demands delivery and gets told, "Sorry, we're settling in cash," will tell everyone. Social media will explode. Trust will evaporate. Every remaining long holder will demand delivery simultaneously, and the system will collapse in a matter of days, not months, days. That is a bank run. That is a classic textbook bank run. Except instead of depositors lining up at a savings and loan, it is futures traders demanding silver that doesn't exist. The mechanics are identical. The outcome is identical. The only difference is scale, and the scale of this one is $22 billion in paper claims backed by $1.1 billion in physical metal. Now, I want to show you something about this chart that almost nobody talks about. The leverage ratio didn't get to 20-1 by accident. It got there by design. The bullion banks who are short silver, the banks who profit when the price goes down, they need the leverage ratio to be high. Why? Because high leverage is how they maintain control. Think about it. If the leverage ratio were 1-1, meaning every paper contract was backed by a physical ounce, the banks couldn't manipulate the price. They would need to actually have the metal to sell it. They would need physical supply to meet physical demand. And if they didn't have it, the price would rise until they did. That is a free market. That is honest price discovery. But at 20-1, the banks can create supply out of thin air. They simply write more paper contracts. They sell more futures. They create phantom silver that exists only in a computer. And that phantom silver competes with real silver for buyer attention. It suppresses the price. It creates the illusion of abundance. It tells the market, "There's plenty of silver, Don't worry, no need to rush, no need to pay more. But there isn't plenty of silver. There are plenty of promises, plenty of IOUs, plenty of electronic entries on a clearinghouse ledger. But the actual metal, the bars sitting in a vault with a serial number and an assay card, that metal is vanishing. And the leverage chart proves it. 4-to-1 5 years ago, 20-to-1 today. If this trajectory continues, and there is no reason to believe it won't, we will be at 40-to-1 within 18 months, then 80-to-1, then 100-to-1. And at some point, the number becomes so absurd, so obviously disconnected from reality, that even the most loyal paper traders will lose faith. They will demand delivery, and the system will break. That is not a question of if, it is a question of when. And chart number 2 is the countdown clock. Chart number 3, the bank net short position. Now pull up chart number 3. This is the one that should be illegal. This is the one that, if the CFTC were doing its job, would result in indictments. This is the chart of the concentrated net short position held by the 4 largest traders on the COMEX silver market. This data comes from the CFTC's own Bank Participation Report and the Commitment of Traders Report. It is published every week. It is public information, and it shows, in black and white, that a tiny group of banks controls the silver price through massive short positions that would be illegal in any other commodity market. Here are the numbers. As of the most recent report, the 4 largest short traders on the COMEX hold a combined net short position of approximately 45,000 contracts. That is 225 million ounces of silver sold short. 225 million ounces. That is more than the entire annual global mine production from the top 3 silver-producing countries combined. 4 banks, shorting more silver than entire nations can produce in a year. Let me give you another analogy because this one is important. Imagine 4 farmers walked into the Chicago Grain Exchange and sold short more wheat than the entire United States produces in a year. What would you call that? You would call it market manipulation. You would call it a cornered market. You would call it illegal. The CFTC would be all over it. Congressional hearings would be scheduled. Investigations would be launched. Indictments would follow. But when 4 banks do the exact same thing in silver, nobody says a word. The CFTC does nothing. Congress holds no hearings. The media writes no stories. Why? Because the banks own the regulators. Because the CFTC is captured. Because the people who are supposed to enforce position limits and prevent market manipulation are funded by, lobbied by, and employed after government service by the very banks doing the manipulation. That is regulatory capture. That is the fox guarding the henhouse. That is corruption dressed in a business suit. Now let me explain why the banks hold this massive short position, because once you understand the motive, the entire silver market makes sense. The banks are not short silver because they think the price is going down. They are short silver because they need the price to go down. There's a difference. A speculative short says, I believe the price will fall, and I want to profit from that decline. A manipulative short says, I need the price to fall because if it rises, I'm insolvent. The banks are in the second category. Here's why. Over the past 2 decades, bullion banks have operated as market makers in the precious metals space. They sell paper silver to investors, to ETFs, to industrial hedgers, and to speculators. They collect fees and spreads on those transactions, but in order to provide that liquidity, they take the other side of the trade. When a buyer goes long, the bank goes short. Over time, as demand for paper silver has grown, the bank's short positions have ballooned. They owe more silver than they can possibly deliver, and the only way they survive is by making sure the price never rises fast enough to trigger a delivery crisis. Because if silver goes to $50, those short positions are underwater by billions. If silver goes to $100, the banks are facing margin calls they cannot meet. If silver goes to $200, which is where some analysts believe the inflation-adjusted price should be based on the 1980 high, the losses would exceed the total capital reserves of the short banks. They would be bankrupt, gone, finished, and they know it. So they suppress the price every day, every week, every month, for years. They use the algorithms, they use the leverage, they use the paper contracts, they use the media, they use the regulators. They use every tool at their disposal to keep the silver price pinned below the level that would expose their insolvency. And chart number 3 shows you the weapon: 225 million ounces of short positions, concentrated in 4 banks, deployed systematically to cap rallies, crush breakouts, and discourage physical accumulation. But here's the thing they can't control: time. The short position is a dam, and behind that dam, the water is rising. Physical demand is increasing. COMEX inventories are draining. Central banks are buying gold at record pace, and silver follows gold. Industrial demand from solar, EVs, and AI infrastructure is exploding. Mine supply is flat because no one invested in new production when the price was suppressed for a decade. The water is rising, and the dam is cracking. Every month that registered inventory drops, the dam gets weaker. Every month that the leverage ratio increases, the dam gets weaker. Every month that industrial demand exceeds mine supply, the dam gets weaker. And when it breaks, when the wall of paper contracts is overwhelmed by the flood of physical demand, the repricing will be instant and violent. Silver will not grind slowly from $32 to $35 to $38. Silver will gap, it will jump $10 in a day, then $15, then $20, because the shorts will be covering. They will be buying back those 225 million ounces, and there is nothing to buy. The registered vaults are nearly empty. The leverage is 20 to 1. The physical market is already in deficit. Where are they going to get the silver? They can't. So they'll bid the price up, higher and higher, until the pain stops, until the margin calls are met, until the system resets at a price that actually reflects reality. That is the short squeeze to end all short squeezes. That is what chart number 3 is warning you about, and the banks are praying you never look at it. Putting all 3 charts together. Now, here is where it gets powerful. Any one of these charts in isolation is concerning. Chart 1 shows a 77% inventory drain, bad. Chart 2 shows 20 to 1 paper leverage, worse. Chart 3 shows 225 million ounces of concentrated short positions, dangerous. But when you overlay all 3, when you see them as a single integrated picture, the conclusion is inescapable. The silver market is a controlled demolition. The inventory is being drained on purpose. The leverage is being increased on purpose. The short positions are being maintained on purpose, and the purpose is to suppress the price long enough for the insiders to position themselves before the system resets. Don't believe me. Look at what the banks are doing, not what they're saying. JP Morgan paid $920 million in fines in 2020 for precious metals spoofing. Spoofing. That means placing fake orders to manipulate the price. They paid nearly $1 billion in fines, and they kept doing it. Why would a bank pay $1 billion fine and continue the behavior? Because the profit from the manipulation exceeds the fine. The fine is the cost of doing business. The manipulation is the business. They are telling you with their actions, with their fines, with their trading patterns, with their short positions, that silver is the most manipulated market in the world. They are telling you because they can't help it. The data is public, the reports are published weekly, the charts are available to anyone who looks. They are just betting that you won't look. They are betting that you'll trust the spot price, that you'll trust CNBC, that you'll trust your broker, that you'll believe the lie. And for 20 years, that bet has paid off. Most people never looked at the charts. Most people never questioned the price. Most people accepted what they were told and moved on. But that is changing. The internet changed it. Social media changed it. Independent analysis changed it. Videos like this one changed it. More people are seeing the charts today than at any point in history. More people are understanding the manipulation. More people are converting paper claims into physical metal. And every ounce that leaves the COMEX and goes into private hands is an ounce the banks can never use to suppress the price again. That is the power you have, not as a trader, not as a speculator, as a buyer, as a holder, as someone who removes real silver from a fraudulent system and says, "This ounce is mine and you will never get it back." Let me do one final calculation because I want this number burned into your brain. 35 million registered ounces at $32 per ounce. That is 1.12 billion. The total deliverable silver supply on the COMEX, the foundation of the entire global silver pricing mechanism, is worth $1.12 billion. Apple has $162 billion in cash on its balance sheet. Apple could buy the entire COMEX registered silver inventory 144 times over. A single tech company has more cash than 144 times the available silver supply. Elon Musk's net worth fluctuates by more than $1.12 billion on a Tuesday. The entire deliverable silver supply of the world's primary exchange is a rounding error on a billionaire's portfolio. That is how small this market is. That is how little it would take to break it. One billionaire, one sovereign wealth fund, one large pension fund, one decision to take delivery instead of rolling paper. That is all it takes. And yet, the banks have convinced you that this market is stable, that the price is real, that there is plenty of supply. They convinced you by hiding these charts, by burying the data in CFTC reports that nobody reads, by wrapping the manipulation in jargon and complexity so thick that normal people give up trying to understand it. But now you understand it. You've seen the three charts. You know what they mean. Chart 1. The vaults are draining. 77% gone. Chart 2. The leverage is 20 to 1. The system is a house of cards. Chart 3. 4 banks are short 225 million ounces, and they are trapped. The conclusion is obvious. The price is a lie. The physical metal is disappearing. The banks are short and cannot cover. And when this system breaks, the repricing will be historic. Not a 10% move, not a 50% move. A repricing that makes the 1980 spike from $6 to $50 look like a warm-up. Because in 1980, the shortage was artificial. In 2025, the shortage is structural. In 1980, the manipulation was crude. In 2025, the manipulation is algorithmic, institutional, and global. And when algorithmic manipulation meets structural shortage, the algorithm loses. Every time, without exception, physics beats math, reality beats fiction, and physical silver beats paper silver, every single time. Here's what you do with this information. You don't panic, you don't go into debt buying silver, you don't sell your house, you don't cash out your 401k, you do what the smart money does. You accumulate, quietly, consistently, monthly. You buy physical silver from reputable dealers. You pay the premium because the premium is the real price. You store it outside the banking system, and you hold it, not until silver hits $50, not until silver hits $100. You hold it until the system that created these three charts no longer exists. You hold it until the paper market is dead and the physical market is the only market. You hold it until an ounce of silver buys what an ounce of silver should buy in a world where the price is set by supply and demand instead of algorithms and bank trading desks. That might be 2 years from now. That might be 5. That might be 10. But it is coming. These three charts guarantee it. The math is undeniable. The trajectory is clear. The end game is written. And the only question is whether you position yourself before it happens or after. Before is cheap. After is impossible. These are the three charts the banks don't want you to see. Now you've seen them. Now you understand them. Now you have a choice. Trust the paper, or trust the metal, trust the algorithm, or trust the math, trust the banks, or trust yourself. The charts have spoken, the data is clear, the manipulation is real, and the clock is ticking. This is John Cashflow. Share this video with someone who still trusts the spot price. They need to see these charts, and I'll see you in the next one.